My name is Gopala Vasudevan. Today we will talk about Chapter 26, Short-Term Finance and Planning. What are some of the things we want to talk about today? We will refer to the cash cycle and why it is important for firms. We will talk about the pros and cons of the various short-term financing policies, be able to prepare a cash budget, and understand the various options for short-term financing. So I think here we are mainly talking about, you know, some how you can finance your assets, especially for the short term, and we are talking about some components referred to the working capital management. So if you go back to chapter 2, if you look at the balance sheet model of the firm, what we said was on the left-hand side, we have the current assets. Then we have the fixed assets. For the fixed assets, we have both tangible and intangible. On the right-hand side, we have the current liabilities. And following that, we have long-term debt and shareholders' equity. And what is net working capital? Net working capital is the current assets minus the current liabilities. And what we try to do here is we want to look at how much short-term cash flow does a company need to pay its bills. So that would be the focus of this chapter. Okay? So when you talk about tracing the cash and net working capital, what are current assets? So strictly speaking, current assets are cash and other assets that are expected to be converted to cash within 1 year. So I think the key here is within 1 year. Now, what are some examples of that? Some examples are cash itself, marketable securities, accounts receivable, and inventory. And basically here, the way they are arranged is in the order in which they can be converted to cash. Now, what about liabilities? So the current liabilities are obligations that are expected to require cash payment within the year. So what are some examples of that? Accounts payable, you have accrued wages. So, your employees have been working, you pay them perhaps every 2 weeks, and these are the wages that have been accrued. And finally, you also have to pay taxes on the income of your business. And sometimes, you also hold the taxes for your employees and you pay them every, as soon as the paycheck is dispersed or on a particular day. So if you look at cash in terms of other elements, okay, so what we see here is net working capital plus fixed assets. So that would be the left-hand side of the balance sheet. That is equal to the long-term debt plus the equity. So what we have is the right-hand side of the balance sheet. Now, what is the net working capital? That would be the cash plus other current assets minus the current liability. So what we are doing here is we are splitting up the current assets into two parts, cash and other current assets, because we just want to figure out how we can get the cash out or how we can, separate the cash from the other elements. And here, cash is given by the long-term debt plus the equity minus the net working capital minus the fixed assets. So this is one way to separate the cash. And why do we care about that? In the next slide we want to see when there is an increase in the cash or when there is a decrease in the cash. Okay, that's what we want to do here. So what is cash? Cash is given by the long-term debt plus the equity minus the net working capital minus the fixed assets. So what it means here is that when you increase the amount of long-term debt, either you're raising money by issuing debt, or if you're raising money by issuing equity, in both those cases, the amount of cash you have on hand will increase. And if you increase the net working capital, or if you purchase more fixed assets, in both cases, the amount of cash will decrease. Okay? So we want to look at so what we find is that if you look at the sources and uses of cash, it basically comes from this equation or this relationship between cash, long-term debt, equity, net working capital, and fixed assets. So we want to look at an important part of this chapter. That is, we want to focus on the operating cycle and the cash cycle. Okay? So typically, let's say you are in business, you place an order for material. So you got an order from a customer, and as soon as you got the order, you place an order for raw materials. The raw materials arrive, and they go to the inventory. And once they are in inventory, you take a certain amount of raw materials towards production, and it takes some time before the raw inventory is converted into finished goods. And that period where the stock arrives and when it is converted to finished good, that is referred to as the inventory period. And then what we find here is that during the inventory period, chances are you might not pay to your supplier as soon as they deliver. You might pay within 30 days or 2 weeks and so on. So that period when you get the inventory from your supplier and you pay him, that is referred to as the accounts payable period. And once you sell the item to your customers, again, they might not pay you immediately. They might take some time. And what we find here is that uh, they have some time to pay, and that is the accounts receivable period. So these are the two components, the accounts payable period and the accounts receivable period. And if you look at the operating cycle of a firm, that is referred to the time period that includes the inventory period and the accounts receivable period. Now, what about the cash cycle period? So that is the time period when you pay your suppliers for the cash, for the materials, for the inventory, and you get paid from your customers. So that is the cash cycle. Now, I'm not sure, whether you read the Apple case, but it is an interesting thing when you look at the cash cycle for Apple. They take more than 90 days to pay their suppliers, but at the same time they get paid from their customers uh, in a far less time period of time, maybe 15 days or 20 days. So their cash cycle is quite different from what we typically talk about with reference to most firms. Okay. Now, what is the cash cycle? So the cash cycle is the operating cycle minus the accounts payable period. And in practice, what we try to do here is that we try to look at each of these. So the inventory period, the accounts receivable period, and the accounts payable period by the days in inventory, the days in receivables, and days in payables respectively. So because you're working for a year, you're looking at things from a year point of view. So how many days is the accounts payable? How many days of accounts receivable? And how many days of inventory? Okay, that these are the things by which you try to look at things. So let's look at an example here. This firm had inventory at the beginning of 200 and the ending is 300. The accounts receivable at the beginning is 160, the ending is 200. The accounts payable is 75 at the beginning, ending is 100. And this firm has an annual sales of 1,150,000. The cost of goods sold is $820,000. So we want to look at these numbers we just talked about. Okay? So if you look at the inventory period, what we want to do is we want to look at the average inventory, and that would be the beginning inventory plus the ending inventory divided by 2. That gives you 250,000. Now, what about the inventory turnover? So we are taking the cost of goods sold, that is 820,000, okay, dividing it by the average inventory. So what we are saying here is that we are turning the inventory 3.28 times every year. So we basically have to replenish the inventory slightly more than 3 times every year. And how many days of inventory do you have? That would be the 365 number of days per year divided by the inventory turnover. So we have 111.3 days of inventory. And usually, higher inventory turnover is better. And the reason being that the higher the inventory turnover, the less you have your money tied up in inventory. Now, what about the accounts receivable policy? So the average receivables here is the beginning plus the ending divided by 2. Okay, that gives you the 180,000. The receivables turnover is the sales divided by the average receivables. So the receivables is 6.39 times. Okay, and the receivables period is 57.1 days. That is good. Uh, no, okay, receivables period is 57.1 days. Uh, so 6.39 times of receivables turnover every year. And the operating cycle, that would be the inventory period, which is 111.3, plus the receivables period, which is 57.1 days. Okay. Now, what about the average payables period? The payables period, the average payables is 75,000 plus 100,000 divided by 2, 87,500. The payables turnover is 9.37 times, and the payables period is 38.9 days. Okay, so the cash cycle is 129.5. So what it means here is that, so the cash cycle is 129.5. So we have to finance our inventory for 129.5 days. So what we are saying here is that between the time where we get the raw material from our suppliers and we finish it and then we sell it to our customers, it takes, what we are saying here is that we have to, you know, our money is stuck. And basically that is after we paid our supplier, we still have to wait to get paid from our customer. And mainly because of that, we have to finance our inventory for 129.5 days. Okay. And the problem here is that the receivables take a long time. That is 57.1, usually it's 30 days and so on. And what we also find here is that the inventory period shows that it's 111.3 days. So perhaps we are keeping too much of stuff in inventory, which basically means that our money is going to be tied up or we have to borrow money to finance this investment. Some aspects of short-term finance policy. So basically here, we want to look at what are the different types of short-term financial policy. The first is, there are two parts to that. The first is the size of the firm's investment in current assets. And what we look for is typically we scale it by the operating revenues. Okay? So how much do we invest in current assets related to our income or related to the operating revenues? And we can have a flexible policy or a restrictive policy. The other is how do we finance our current assets? And what we try to do here is that we want to look at a short-term debt to the long-term debt, and we can again refer to them as flexible or restrictive policy. Okay. So what is the size of investment in current assets? Okay. What is the restrictive policy and what is a flexible policy? So flexible policy means that you're going to keep large cash balances and investments in marketable securities. Okay, and the reason why we want to keep them is because we want to have flexibilities, and that way we can have cash as quickly as we need it. Large investments in inventory, so that whenever there is any certain order, we can meet that quickly, and we are liberal credit terms. So we are going to give it to our customers on very flexible terms. And what is a restrictive short-term finance policy? What that means is that keeping low cash balances, so you don't have much money in the bank, no investment in market-based securities, a small investment in inventory, allowing no credit sales. So this is a very extremely restrictive policy. We are saying that we only take cash, okay? And we are basically saying that uh, keeping low cash balances. Okay? So if you look at the carrying cash on the shortage cost, what is the benefit, pros and cons of this? So here, uh, what we find here is that the carrying cost basically tells you, it is a measure of your holding inventory and so on. And what we also see here is that the shortage cost. So if we have a liberal policy, okay, we may not have much shortage, and the shortage cost would be very low. Okay, and carrying cost would be relatively high. Okay, and this tells you where the total cost of holding current assets. You want to pick a point where you can minimize those costs. Okay, and what is a flexible policy? So in the case of flexible policy, our shortage costs are low, our carrying costs may be relatively high, and total cost of holding current assets are also relatively high. So we want to pick the place where you can minimize some of these costs. Okay, that's what it's a. We are flexible, but at the same time, we don't want to be, have too much money tied up and so on. Okay, that gives you the investment in current assets. So we want to pick a point where our costs are minimized, although we have relatively flexible policies. Now, what about a restrictive policy? So in the case of a restrictive policy, what it means is that you're not going to put much money uh, in your current assets related to sales. And what that means is that your shortage cost will be higher, your carrying cost would be lower, and total cost of, again, we want to pick a point where it is minimized. Okay. Now, what about the financing policies? A flexible short-term finance policy means that you are a low proportion of short-term debt relative to long-term debt financing. So a restrictive short-term financing policy means that a high proportion of short-term debt related to long-term financing. So in a flexible policy, you're not borrowing too much in the short term. You're financing mostly with long-term debt. So in a scenario such as now, where interest rates are relatively low, it makes sense to finance mostly with long-term debt, although there could be a slight mismatch of our uh, use and our financing methods. On the restrictive short term means that you have a high proportion of short-term debt related to long-term debt. So there could be two reasons. One, short-term debt is cheap. The second could be, sometimes firms that are not that great in terms of credit risk and so on, lenders might not go for long-term financing. So ideally, short-term assets are financed with short-term debt, and long-term assets are always financed with long-term debt. Okay, so the next thing we want to talk about is a cash budget. So if you are, working in a firm, clearly the headache you have is working capital management. How do you manage it on a daily basis, and how can you figure out how much cash you need to sustain your business and to avoid any shortages and so on? So a cash budget is a primary tool of short-run financial planning. And what are we doing here? We want to look at the estimates of cash receipts and disbursements. So what are the cash receipts? Uh, Basically, as we sell, we get cash, but I think the hard part is figuring out when we actually going to collect. Okay, so that depends upon our accounts receivable policy. Now, what about the cash outflow? So that depends upon our accounts payable policy. We also have to pay wages, taxes, and other expenses. We might have investment in fixed assets, capital expenditures. And the last thing is we also want to look at the long-term financial planning. Okay, so in this case, we are looking at a firm that is pet treats. They specialize in gourmet pet treats and receives all income from sales. Now, what are the sales? In quarter one is 500, quarter two 600, quarter three 650, quarter four 800, and next year their estimate is 550. Okay, so we are given 1 year. Accounts receivable, the beginning receivables is 250. The average collection period is 30 days. The accounts payable, if you look at their policy, their purchases are 50% of next quarter sales. So that's an important thing when you look at the analysis. Okay. Beginning payables is 125. The accounts payable period is 45 days. Other expenses, wages, tips, and other expenses are 30% of sales. Interest and dividend payments are 50. A major capital expenditure of 200 is expected in the second quarter. The initial cash balance is 80, and the company maintains a minimum balance of 50. Okay, so based on this, we want to look at some projections for the cash budget. So basically, if you look at the receivables policy, the average collection period is 30 days. So what that means is that for every quarter, 2/3 of sales are collected in the quarter made, and the remaining 1/3 are collected in the following quarter. The beginning receivables of 250 will be collected in the first quarter. So the beginning receivables is 250. The sales are 500 for that quarter, and the sales are 500. So the cash collections is going to be So the cash collection is going to be 583. So that is going to be uh, what we find here is that the 2/3 of the sales for this year, okay, and the 250 from the previous quarter that is holding, okay. And what is the ending receivables? Because you already collected 333, 167 is the receivables outstanding. So for the year, for that quarter, you had 500 in sales, you collected 2/3, you still have to collect 1/3 of that. Now the next quarter, it's going to be 167. We just want to move it to from ending receivables go to quarter two, and the sales are 600. The cash collections are 567. Okay, so that would be the 167 is collected, and 2/3 of this one. So 2/3 of 600 is going to be 400 plus 167. That gives you the 567, the cash collections, and the ending receivables are the 1/3 that is not collected. So that gives you the 200. Now, again, for quarter three, we're going to do the same thing. The cash collections are 633, and the ending receivables are 217. Okay, so the beginning of quarter four, Again, we have 217 to start with. You're going to sell 800. So we have we're going to collect 2/3 of that, and the 217 from the previous quarter, that gives you a cash collection of 750, and what is remaining is 267. That is the from the quarter four. Okay, now what we want to do is we already talked about the receivables and how the cash is changing because of that. We also want to look at the payables. Now the payables period is 45 days. So what that means is that so half of the purchases will be paid for each quarter. Okay, and the remaining will be paid the following quarter. So the beginning payables is 125. So what we find here is that the payment of accounts. Okay, we are buying 600. Okay, so we bought 600 in the second quarter. Okay, 600 in the second quarter. That is what we have. So half of that, okay, is the okay, so that's what we have here. So we pay half of the purchase will be paid for each quarter, and the remaining will be paid the following quarter. So out of the 600, what we find is that okay, so 600 is what is we are buying, and we're going to pay half of that. So the payment of accounts we see here is going to be 333. Okay, sorry, 313. Now wages, tips, and other expenses are 180. Now it also says that for that quarter there is a capital expenditure of 200, and interest and dividend payments are 50. So overall, our cash disbursements are going to be 743. Okay, that is 313 plus the 200 plus the 180 plus the 50. Now in quarter three, what we have to do is we have to pay for half of the purchases. Okay, and what we see here is that so 50% of next quarter sales are being bought. Okay, we got to pay for that, and the quarter four is going to be 800. Okay, 800 for 400. We pay half of that, 200. Wages, tips, and other expenses are 240, and interest and dividend payments are 50. So the total cash disbursements for the fourth quarter is going to be 628. Now we want to put it together. So for the first quarter, the total cash collections is 583. The cash disturbance are 475, and the cash inflow is 108. Now we also said that at the beginning of the quarter, our cash balance is 80. And what we find here is that the net cash inflow is 108. So the ending cash balance is going to be 188. Okay, so that is what we see here. Now, it also said that the minimum cash balance we want to have is 50. So what we have is we have much more than that. We have 138. Okay, now the second quarter, our cash collections are 567. The disbursements are 743. The cash inflow is a negative 176. Now because we had sufficient cash at the beginning, we had 188. The cash inflow is going to be 176, a negative number, and the ending cash balance is 12. Okay, so that is below our minimum balance. Quarter three, we collect 633. The cash disturbance are 607. The cash inflow is 26. The beginning cash balance is 12. And what we find here is that the ending cash balance is 38, again below our minimum requirement of 50. Now for fourth quarter, our cash collections are 750. The cash disbursements are 628, and the cash inflow is 122. What we find here is that the ending cash balance is substantially higher than the minimum cash balance required. Okay, so what we find here is that there is a shortfall, and the highest shortfall we have is the negative 39 in quarter two. And as we see here, the main reason why we have that shortage in quarter two is because of the high capital expenditure of 200 in quarter two. That may not be a normal time for most companies. This could be something maybe planned or something like that, but we're not sure about that. Now, how do we finance that shortfall? So typically, the most common way to finance a temporary cash deficit is to arrange a short-term loan. And how do we get a short-term loan? So typically, if you're a small business, it might be difficult to go to a bank and get that amount. So typically you might have to go for an SBA loan. So the banks are willing to give it because SBA loans are secured by the guaranteed by the government. So that is typically what you see in the case of a lot of unsecured loans. Now, if you're an established company, you do a lot of business with the bank, they know you well, they'll be more than happy to give you a line of credit. The others are secured loans. And what are secured loans? Accounts receivable can either be assigned or factored. Uh, that is, these are the two choices in terms of the secured loans. And a lot of the time, you can also get an inventory loan where you're going to use your inventory as collateral. Now, for larger firms, what else can they do? They can have a banker's acceptance, which means that the bank is giving them guaranteed short-term financing, or they can go to the financial markets and issue short-term debt. So in the case of U.S. government, we said those are treasury bills. In the case of companies, when they raise money, this is referred to as commercial paper. So this is pretty much, what you want to look for as far as this chapter is concerned. What are some of the things you want to focus on? The first is how do you compute the operating cycle and the cash cycle? Those are different. Those are important. What are the differences between a flexible short-term financing policy and a restrictive one? What are the pros and cons in terms of, as far as financing is concerned, as far as keeping customers happy is concerned, and so on. What are the key components of a cash budget? Okay, we went through one. And what are the major forms of short-term borrowing?